Hello everyone, I'm Matthias, and in today's video I'm gonna talk about Netflix, a company that I find very interesting. Today I'm gonna explain why. So to most investors, it's no secret that Netflix stock has performed poorly over the last 6 months. There was this whole Brazil tax thing, and now also the purchase of Warner Brothers is sort of hanging over the stock price. The stock has been deemed dead money for the next year because of the lack of visibility in regards to the Warner Bros. Acquisition. The reason I'm looking at Netflix is because I have a 2.5% cash position. Now, I want to deploy this cash position, but I'm not willing to do that at any price. I'm looking at a lot of different companies, and Netflix is just one of them. But I have this 2.5% cash position that I want to deploy, and I'm looking at Netflix. But remember, before we head into that, this video is for general information purposes only and does not constitute investment advice or solicitation to buy, sell, or hold any securities. I am an employee of NewDeal Invest, and NewDeal Invest owns Netflix shares. However, the views expressed in this video are my own and have not been reviewed or approved by NewDeal Invest. This information that is provided is based on public sources, which may contain errors. Forecasts and price targets are subject to uncertainty. Past performance is no guarantee for future results. I may hold positions or trade the securities mentioned. Now, the reason I'm seriously considering Netflix is because I see it as this lifetime value optimization machine. I've had a Netflix subscription for multiple years. I don't see myself switching away. Now, also, I see this company having massive pricing power. I don't remember how many times they've increased prices with customers just staying on the platform, but they've successfully managed to do this because they increase lifetime value. So Netflix is a beautiful and wonderful platform company because it functions as a self-optimizing machine, a machine that just over time optimizes lifetime value. Another thing that I find very interesting with Netflix is their structural runway for growth. Obviously, streaming has to a certain degree disrupted traditional television broadcasting, right? But there's a lot more runway to go. We see streaming making up 44.8% of TV time in American households, and this is a growing trend. We see the numbers going higher and higher from May 2024 to now May 2025. So basically, what we have is structural growth in the market that Netflix operates in television, right? And also, we can zoom in on streaming and make it streaming specific. So this is the Nielsen research study that has become so famous. But what we see is Netflix actually losing market share over the last couple of months to now only being 7.5% TV watch time. So what my idea is that Netflix has structural runway for growth. It is not a company that has tapped into all the white space. It is not a company that has conquered its space. It is still a relatively small player. Now, obviously, it's one of the biggest players, right? But what we have is a company that structurally just keeps on improving their value proposition. They keep on improving lifetime value. So my idea is that Netflix has structural run rate for growth. Netflix has plenty of space to grow into. It's not a saturated market. And what we also have is not a company that is a monopoly. There is a lot of competition in this area. I don't want to go into all this. I think Joseph Carlson beautifully covered this. So I'm not going to do that. So as I mentioned, Netflix share price has declined over the last couple of months because of a multitude of different aspects. Especially this acquisition of Warner Bros. HBO really has put pressure on the stock price. But my idea is, and I will quickly go into this later, is that Netflix with this purchase will unlock a lot of value. It will fundamentally change the value proposition for Netflix. The value proposition in itself is lucrative at this moment. But what I'm trying to get at is Netflix stock price has declined by a lot over the last 6 months. So does this mean the stock has finally become cheap? Does this mean that this stock, based on the discounted cash flows, is a good buy? Now, when it comes to the reverse discounted cash flow model that I have made on Netflix, I've taken their cash flow from over the last 12 months, this $8.9 billion, and a terminal growth rate of 0. I do not think Netflix is going to stop growing after 10 years. I think Netflix is going to be around for a long time. I think Netflix, as I presented in the start of this video, is a machine of self-optimization. For every user that gets on the platform, they get a bigger proprietary data set. They improve their models of content matching, they improve their content recommendation models, and they improve the feedback they get on the content they have available on their platform. So I do think this company will be around for a very long time. But I find that using terminal growth rate at 0% does give you a certain degree of margin of safety. So that's what I'm doing. Where you take the cash flows at a discount rate and you discount them back to today's value, Netflix will have to grow at 22% for 10 years on average. Now, this is quite steep, and this does not present the screaming purchasing opportunity that a lot of people on YouTube say it is. In my opinion, when you look at this model, Netflix is not the screaming purchase. Netflix is not the screaming buy. But using these models doesn't capture or gauge the full value creation. Now, these models were made, as Matt said, for companies that had hard assets. So these valuation methods are not made for companies that run on huge proprietary data sets. With network effects, data feedback loops, flywheel effects, and massive proprietary data sets, these companies are extremely lucrative, but putting a price on these assets is very tough. Doing a discounted cash flow model doesn't gauge the whole value creation. Now, getting to the network effects, every time Netflix gains a new subscriber, they improve their contextual understanding of their platform and of the end users. So what they get is data feedback on what sort of content X user likes to watch, and then they can better recommend content for that user. A massive point of friction on other streaming platforms such as HBO, Amazon, is just the sheer amount of time you have to spend on finding a new series to watch, a new documentary to watch, a new movie, right? But what Netflix does wonderfully is recommending these very well created, beautifully crafted documentaries, series, movies. So that removes a huge point of friction, in my opinion. So where does that show up in the balance sheet? Where does this immense data set that they have show up in the balance sheet? Their over 300 million users provide them a lot of data so they can better tailor the content they purchase, so they have more context on what content to purchase and what content to recommend for the end user. So these are network effects, because every time a new user comes on, they get more contextual understanding of their platform. But it's also scale and proprietary data scale moats. So these moats, these competitive advantages, really does drive a lot of future value for Netflix. Where does this show up in the balance sheet? Where do these feedback loops show up in the balance sheet? These sort of flywheel effects, every time a new user comes on to Netflix, it becomes better at recommending content, better at knowing what sort of content to buy, better at doing these different A/B tests, so they have more different users to run tests on. They have so much context. Where does this show up in the balance sheets? So what I'm trying to get at is, just looking at the share price and seeing it as decline does not mean Netflix is cheap. Looking at this discounted cash flow model, seeing that it has to grow its cash flows for the 22% over the next 10 years does not mean that it's expensive. You have to gauge this. You have to go in and look at these value creation processes for this company and find out whether you know something that the market does not know. Now, I think the market is kind of pessimistic on Netflix. I think the market doesn't see the value creation from this Warner Bros. And Discovery purchase that they're trying to do. But also, just because the share price has declined does not mean the stock is cheap. It means that it's less expensive, but does not mean that it is cheap. You as an investor have to think in absolute terms, not in relative terms. These are relative terms. The share price is a relative term. What you have to gauge is the value creation of these companies. What I'm seeing with Netflix, moving into the sort of fundamental development of this company, I see a company that is fundamentally changing its value proposition. What we used to have was a company that was driven on subscriber gains. So now we see they stopped reporting the total subscribers in 2024, right? But what we see is a company where the value has been driven by subscriber growth. Value was gained when a new customer, a new user logged on to Netflix. What I see is a company that is fundamentally changing. Now, going into their Q3 2025 earnings report and reading this is a marvel to behold. But what I think is very interesting is that we're seeing a company that is increasingly going from subscription to an ARPU story. So an average revenue per user growth story. So what we're seeing is a company that is increasing its earnings from its ads business, right? So it says here we have a solid foundation and are increasingly confident in our outlook of our ad business. We are now on track to more than double our ads revenue in 2025, still of a relatively small base. They're increasingly finding demand for this ads tier. So what this does is fundamentally changing Netflix from a subscription revenue company to a mixture between subscription revenue and ads revenue. As I did mention, this immense data set that they have, this incredible flywheel feedback loop effect that they have, is that for every new user they get on the platform, they get increasingly better at recommending content, right? So I'm gonna play you a little clip from Jensen Huang here from NVIDIA talking about how these content recommendation systems really create value.
The second is revenue boosting in their current business models. Recommender systems drive the world's hyperscalers. Every single, whether it's, watching short form videos or recommending books or recommending the next item in your basket to recommending ads to recommending news it's all about recommenders. The internet has trillions of pieces of content. How could they possibly figure out what to put in front of you in your little tiny screen unless they have really sophisticated recommender systems to do so?
Now, with an increasing amount of users and an increasing data set in order to recommend the right content, don't you think that they'll be better at recommending better ads? Don't you think they'll be more contextually aware to sort of recommend the right ad to the right user? Don't you think that they'll increase their value earned because their ad context is just much better than other streaming platforms? I certainly do think so. I think Netflix is going from a subscription story to an ARPU story, becoming more efficient in terms of recommending content to the right users. So this sort of changes the whole value proposition for the company. A brilliant place to be for insights on Netflix is X following CapEx and Chill. He has this very interesting insight on Netflix saying that it has critical attention data. And this is what I just said. Netflix knows exactly what their users like to watch. They know where the user's attention is. They know what sort of content to show each individual user, and also at a bigger scale, they know exactly what sort of content to purchase to move onto their platform. So they have these both macro and micro levels of content. So they know in general what sort of content their users want, and they know exactly where the individual users attention is. So in my opinion, Netflix is very well positioned to sort of grow into this ARPU based story, growing their revenue per active user in these ad tiers because of their beautiful, wonderful content recommendation systems, because of their massive contextual insights, and also because of their insights in terms of user attention. So what this is Netflix changing and fundamentally developing into a sort of multi-revenue stream company, but also an ARPU story. So this is a very interesting shift in the value proposition for investors, but also to their customers. Being shown contextually valid ads is a good experience. It can be product discovery. It can be your way of discovering products. It can be your way of expanding your insights. It can be your way of being made aware of things that are relevant to you. So ads, if done correctly, can actually enhance user experience. Instagram is a wonderful example of this. Another thing that is very good about this whole ads thing is that it's very high margin. So the money they earn on it, they get more money in because ads is just more high margin. Also, they're going into live events. This is no secret. We just watched the Jake Paul and Anthony Joshua fight. They're going into live events with WWE as well. So they're increasing their value proposition. Their subscriber churn will be positively affected by including live events. What you usually have and what you can have when it can be an issue for Netflix as a company is they have these huge titles such as Stranger Things, and people log in, watch those, and then they just cancel their subscription after having watched it. What live events does is sort of anchoring and sucking in those users and making them stay on the platform. Now, what I see is Netflix moving into sports, going in and expanding this live events offering in order to reduce subscription churn. Once again, on X, I'm back at the Capex and Chills posts here, but he has this wonderful graphic of Netflix fundamentally changing. As I mentioned, they had this model that was based on more subscribers leading to more growth. What they have now is reducing subscription churn based on these live events, as I just mentioned. These sort of keep and glue these customers to the platform. Also, they have this high margin revenue stream of ads. Also, they're increasingly moving into gaming experiences. I play Football Manager on my phone using my Netflix account. So they sort of increase the value proposition for users by doing this, by having live events, by having ads that are contextually relevant, and having gaming experiences. These increase the overall lifetime value for their customers. So to conclude on this point, Netflix is changing their value proposition for their investors and also for their end users. For the investors, Netflix gains more sustainable, high margin, long term revenue streams. They reduce subscriber churn by increasing these offerings in terms of live events. They also improve lifetime value, adding games. They make it more social, from a subscriber based story to an ARPU story. Another thing I want to get into is how they increase their value proposition by doing the Warner Brothers and Discovery purchase. Now, let me make it clear, I do not think that this purchase is alpha omega for Netflix. If this does not go through, I still think the Netflix thesis is unchanged. Netflix will continue to be a lifetime value improving machine. Netflix will continue to expand their offerings. Netflix will continue to gain money from ads. They will improve fundamentally with or without the HBO acquisition. But what this acquisition will do is, to a certain degree, change the landscape in terms of content that is available on Netflix. And also, they gain very, very industry valuable intellectual property. This point has been beaten to death, but it is very important. I'm not gonna go into the nature of this deal. It has been covered to death on YouTube, especially by Joseph Carlson. You should watch his videos in order to gauge the nature of the deal, the pricing of the deal, and so on and so forth. Now, with above $80 million, this deal is quite pricey, right? But remember what you have to pay for. You pay for these very, very ingrained, culturally significant intellectual properties such as Harry Potter, Game of Thrones, The Walking Dead. Now, Netflix is a company that, anyhow, just spends a lot of money on their content. They have to do so. Their model relies on them purchasing content and presenting it to the users, right? But what we have is a company that spends a lot of money on content. We can see in 2025, they've spent 12 billion. In 2024, they spent 16 billion. Now, they also get a huge amount of value out of this content, but generally, they have increased the amount of money they've spent on content. Already spending huge amounts of content, taking risks and taking chances. Now, Netflix, with the purchase of Warner Brothers Discovery, purchased what they already know works. Also, they talk about having value that is still unlockable in these franchises. So let me just play a clip of what one of the CEOs had to say about this.
The first part is there's a bunch of titles that the Warner teams have that we think that there's more value to unlock in, and we think we have exactly the platform to go do that. We've got incredible reach. We've got a project experience that maximizes the value in content.
We believe we've got the best tool for connecting incredible stories with people around the world, and we think actually bringing more of that Warner Brothers content into that tool, if you will just unlock value in and of itself.
So they talk about having a lot of value yet to unlock, and Netflix being the perfect platform to unlock this value because of their ability to sort of recommend these wonderfully well-produced series that just didn't get enough exposure being on HBO. They have the perfect platform to solve this point of friction. Now, also, in terms of buying what they already know works. Let's hear a clip of them talking about them doing something that they already are.
This is the business that we are in. Essentially, we are constantly in the business of evaluating various different licensing opportunities for titles and then trying to figure out how do we maximize the value of that asset on our platform. So again, that's something we do day in and day out and we think is relatively low risk to execute.
So purchasing Warner Brothers Discovery will unlock a lot of value for Netflix. This will be longer term lifetime value. I mentioned Netflix being a lifetime value optimization machine. What they do with this purchase is just continuing down that road. They have the perfect platform to unlock this value, and they are also just doing what they normally do at a bigger scale. They become a full on ecosystem rather than just some streaming platform. So hopefully at this point I've managed to cover why I think Netflix declining in price doesn't make it a screaming buy, but both the discounted cash flow model and the decline in share price don't tell the full story. Looking at the decrease in share price doesn't mean that Netflix is cheap. Looking at the discounted cash flow model doesn't mean that Netflix is expensive. You have to look at these contextual pointers. Also, I don't find Netflix to be the screaming buy that everyone else does. But I think when you look at it with context and when you take a broader approach, Netflix does definitely present an interesting value proposition for investors and for users. I still have not made up my mind. But overall, I still do think that Netflix is an interesting case. They are this machine of long term compounding of lifetime value while also having immense pricing power. They still have a lot of structural growth to gain and unlock, with unlocking more time spent on television, still disrupting old cable television. They have a lot of structural runway for growth. They are fundamentally changing their investor value proposition from a subscription-based story to an ARPU story. This means that they get a broader array of long-term sustainable growth levers that they can pull with ads, gaming, live events, increasing their lifetime value. What this does is sort of rendering these discounted cash flow models irrelevant. I'm not saying that you shouldn't price these companies. What I'm saying is that you have to sort of be more contextually based. You can't just look at these models. You can't just look at the share price. You have to base your research on concrete things. So I hope you guys enjoyed watching this video. I hope you guys learned something about Netflix. Remember that this isn't purchasing or selling advice. I hope you guys learned something. I hope you enjoyed the video, and thanks for watching.